I'd like to welcome my guest. He is business and finance journalist Bryan Borzykowski to our show. Bryan has interviewed me many times, so this is actually going to be a lot of fun. I get to turn the tables and ask Bryan some questions this afternoon. His work has appeared in the New York Times, on CNBC, BBC, as well as BNN Bloomberg and the Globe and Mail, among other media. And he regularly appears CTV News and SiriusXM. Bryan also is the founder and editorial director of All Caps Content, an agency that creates branded content for financial, tech, healthcare, and professional services firms. He has authored several personal finance books. I'd like to welcome to the show, Bryan Borzykowski. Good afternoon, Bryan.
It is good to see you, and it is nice to have the tables turned this time. Thank you for having me on your show.
Yeah, it's always great. I know we've done a lot of interviews together, and like those interviews, our interview today, I don't really look at it as an interview, more as a chat, I guess. Kind of just a casual conversation about what's going on in the world today, the world of finance. So, with rising interest rates on the minds of most people these days, Bryan, what is your opinion and what are you hearing from people you've spoken to lately regarding whether we've seen the last interest rate hike in Canada and in the US for that matter? Or do you think there's another one coming at some point in the fourth quarter?
I'm going to preface this by saying that out of the last year, out of all of this, nobody knows anything that's going to happen next. So it's amazing that we've been talking about this because I still, it wasn't that long ago that central banks were talking about inflation being transitory. And there was nobody that thought that interest rates would rise this fast, this high, this fast. So really, who knows? But I think the Federal Reserve has said that they do expect to raise rates again, at least one time. And when inflation isn't at that 2%, and if that is the target that central banks want to get to, and it still is, then they're probably going to have to get there because they're going to have to raise rates again to get that down. Going from 8% to maybe 4%, I think that was maybe some of the easier work that had to get done. Getting from 4 to 2 is not going to be as easy, and so that's I think what we're seeing now is how do they get that back down to 2%? I hope there's not a rate increase. I mean, the people I talk to. I'm talking to my friends who own homes. I run my own business, talking to other business owners, talking to lots of different people just in my course of work as a journalist and in the finance industry. And I think people would like things to kind of settle down right now. So nobody really wants to have another rate increase. Will we have a rate hike? A rate decrease? That's a whole other question, and probably not for a while. But again, if they're not going to get to that 2%, it does feel like we could see another hike at some point. I feel like we're close, though, to the end. People are getting stretched. I think that's pretty clear.
Yeah, and it's interesting. Yeah, I always talk about, is 2% even realistic, right? Like going from, like you said, from the 8 to the 4 happened fairly quickly, although not quick enough for, I'm sure, for the central banks. Going from 4 to 2, don't know if we actually can ever get there, right? With higher oil prices now kind of taking us in the other direction, is 2% even realistic in today's economy? And I think that's something that, it's been asked of the Bank of Canada and the Federal Reserve as well.
Yeah, and that's when I've interviewed fund managers and doing my own webcast with people, they seem to say that, and I pose this question, and they seem to say that they're going to stick to that 2%, but it is a question I think worth asking. I'm not an economist, and that's way above my pay grade, so I don't know the implications of sort of the central bank saying all of a sudden, hey, we're going to try and go to 3% or 4%, and the long-term implications of that. But clearly, they don't want to do that, or they would have done it already, I think. So they are still sticking to that 2%. They're still talking about that 2%. But it is a good question. How hard is it to get there? And what happens if we don't? And I think that's still a very open question right now.
Yeah, for sure. For sure. And obviously, because of these higher rates that we're dealing with right now, markets struggled in August to a certain degree, although the back half of August, they rebounded somewhat. We had a very rough September. With all that now in the rearview mirror, I've talked about perhaps a positive fourth quarter, but what do you think? Is there a reason to be optimistic for the fourth quarter? If so, what do you think the catalyst can be for a positive end of the year?
I mean, if you asked that maybe 2 weeks ago, perhaps there would be a bit of a different answer. But with fourth quarter, we're just starting October, and things aren't looking great. I mean, the S&P TSX is now below, in negative territory. The S&P 500 still about 11% high up on the year, which is decent, but not kind of where it was a little while ago. I think to me, it's everything is very uncertain. I think what we're seeing now is the bond yields, long-term bond yields increasing. That's putting a lot of pressure on stocks, because really the bottom line here is if you can put your money into a bond or a GIC paying a higher rate than you can get at then you can get taking on the risk of the market, you're going to put it into the GIC. I mean, you asked before about what am I hearing? Just conversations with my friends on WhatsApp. We were talking about this yesterday, and a friend of mine is like, I'm putting my money into a 6% GIC, and that's it. And hard to argue with that. My money's still in the stock market, so it's not great. But so I think the more people that figure that out, and if we see rates rise again, then I think the equity market will struggle. I think there's also some concern about how optimistic earnings are for 2024. There were optimistic earnings at the beginning of 2023. Those got downgraded, which made it easier for companies to beat analyst expectations. They're still lower than they were at the beginning of the year. They did beat analyst expectations. So we saw some positive momentum from some of that. But I think to me, it comes down to kind of where do the bond rates and interest rates settle? And are people going to pull back on spending? And I think we're starting to maybe see a slowdown. In Canada, we saw, GDP numbers have been flat. Employment's getting a little weaker. And so I think if we start seeing that people stop spending, it's going to be hard for these companies to kind of generate earnings. And if we see that in the States too. So I think there could be you can never predict the bottom. So is what we're seeing now, the decline the last, little bit, is that going to be enough to kind of get things to the bottom and rebound again? I have no idea. But I think that it could probably at the very least be a rocky year ahead.
Yeah, and it's interesting. You mentioned the people that you speak to. I guess, a lot of money managers I know that you speak to over the last little while. What are they saying in terms of, are they more negative than you would, than you thought they would have been? Do they talk about the big bad word, recession? Do they think Canada and the US perhaps will fall into some sort of mild recession? Is that what the money managers are telling you?
It's interesting. Everyone's got a different opinion. Even people from the same companies, they're just, it's hard to know. And everyone kind of looks at different things. And so it has been a bit of a wide range of sort of thoughts on whether there's a recession. I think a lot of people now are expecting more of maybe of a soft landing. So not, the big deep recession that maybe people were thinking before. We are still seeing decent growth in the States. Again, jobs haven't fallen off the cliff like you might see in a typical kind of deeper recession. It feels like we're just kind of maybe moving along here, taking some dips. And so I think there still will be a recession. And I think people do expect something is going to happen. Maybe we're in one now. Again, we're seeing GDP numbers. We were negative the last quarter. It's kind of flat this quarter. We could, at least in Canada, we could be in one now. But it may not be the big decline. Now, of course, that a lot of people are nervous about a housing crash. I'm not as I think the people are resilient. I think the housing market may not, what's a crash? 50%. It's hard to see that happening. Prices are softening. But if we do see a big crash and people need to sell, or we're putting people in a tough position, then yeah, maybe there could be a much deeper recession in Canada. I think that's partly why we're seeing the Canadian markets fall more than the US markets, because nervous over the financial sector and people paying their mortgages. We haven't seen kind of yet the renewals, I think, in a big way that hasn't shown yet what's going to happen. And that's coming. So it could be a deeper recession here. But the people I'm talking to, I think consensus is yes, recession, maybe not as hard as we had thought a few months ago, something softer, but we probably won't avoid it.
Right. And I guess for my last question, I want to kind of tie things back to my first question. And, both of us have mentioned interest rates. I don't know how many times in our conversation just now. And obviously these higher yields on primarily government, US government treasuries, government bonds, with the 10-year now approaching 5%, the 30-year going over 5% recently. Obviously, this is causing a lot of grief for the equity markets, for the stock market. But this is something we've known. We've known the Fed is going to move rates higher. Why do you think interest rates are moving now, and why are they moving so fast? Is it just simply people are now finally coming to grips with what the Fed and Bank of Canada has said all along?
I think there's something to be said for that. Yeah. And you're right. I mean, the market works in weird ways. You sort of see these things coming, but, things don't kind of react right away, or sometimes they overreact initially and then rebound. And so it's hard to know exactly why now. I guess there's a couple things. Is that the Fed, did say that they're probably going to have to raise rates another time. You're starting to see much more quantitative tightening. So the Fed is selling, bonds into the market. They're kind of flooding the market with bonds that they had purchased during the quantitative easing, and that I think is putting a lot of more supply into the market. So rates have to go higher if anyone's going to buy that supply. So I think we're starting to see that. I have a chart on my other screen here looking at kind of how things have declined, and it really has picked up since about April. A lot of the Fed's balance sheet has really kind of declined because they're selling some of those bonds. So I think part of it is just people kind of figuring this out, plus that announcement of interest rates. And as we get to the end of the year, the Fed did say likely another rate hike before the end of the year. We're not that far off. And so I think as we get closer to that, maybe the market's anticipating this hike's going to happen, maybe more hikes. It's amazing. Midway through the year, there was an anticipation, and I never understood it, but that there was going to be, 2 or 3 cuts before the end of the year. And I will say most of the people I spoke to did not understand that either, but the market was pricing those cuts in, thinking, I guess the recession would be worse. The Fed would have to act. Clearly that's not happening now. And it wasn't that long ago that those cuts were priced in. So now they're not priced in anymore. They're priced in for next year, but there's an expectation that the rates will just get higher. And I think that's what's happening now.
Yeah, it's interesting. Like you said, the the recession that they were predicting for midway through this year, they've now pushed that off to sorry, my throat's a little sore, midway through 2024 now, maybe even beginning to midway through 2024. So yeah, it's I don't even think the Fed knew or can predict, like you said, it's too far out. When they first started this hiking cycle, they thought maybe a few hikes and they'd be done. Here we are 10, 11 hikes later, and they're still talking about perhaps one more. So yeah, central banks, I think they're just going with, as they say, following the data and adjusting accordingly. So it'll be interesting to see what happens in the fourth quarter. But Bryan, I want to thank you again for coming on the show, for allowing me to turn the tables on you and ask you all the questions this time. You've been great, giving us some great information, some insights as to what you're hearing out there and what you think. And thank you so much for being on today.
Thank you so much for having me anytime, and great chatting again.
All right. Excellent. Take care. We'll talk soon. Now we come to the part of the show where I talk about what I believe is important for individual investors to consider before you make your investment decisions over the next couple of weeks. As always, we have 3 topics, and look at that. The Fed is actually not one of the topics. I know we've had Fed speak on as a topic for a number of shows in a row. However, we do have U.S. Treasury bonds, which we just spoke to Bryan about. The rise in interest rates, government bond rates in the U.S. predominantly, how they affect the market. Number 2 would be look for a change in tone of the markets. October tends to be that month where things come in negative, but there's a change mid-month and come out of the month a lot more positive, and November tends to be one of the more positive months of the year. Third, corporate earnings. Corporate earnings season will begin in the next week to 10 days. Really, I say that corporate earnings season doesn't kick off until the U.S. banks start to report earnings. And we'll talk a bit about the 2 biggest banks in the United States, which will report first, JP Morgan, Bank of America, along with other large banks like Citigroup, Goldman Sachs, Morgan Stanley, et cetera. But overall, the corporate earnings season, at least the start of it, will go a long way as to tell us, the state of the U.S. economy and the state of the economy as a whole. So let's move to the first topic, which is U.S. Treasury bonds, or government bond rates. And we have a chart I want to show off the top, and this shows us all the rates. It's a pretty recent chart showing us 1 month rates, 4 month, all the way out to 30-year rates. You can see it here on the screen. And what you'll notice right away is that the shorter end of the curve, so the 1 month, 2 month, 3 month, is higher, paying higher interest than the 30-year, which is opposite of what you would normally see, right? And we talk about this as being an inverted yield curve, when the short end is paying you more money than the long end. And so therefore, you ask the question, well, who's going to buy a longer term bond, let's say a 7-year US bond, when you could buy a 2-month bond and make almost 5.5%? So of course, this kind of plays around with investors and what they decide to do. But overall, make no mistake, as interest rates have moved higher in the US, the 10-year approaching 5%, I think it's around 4.8 today. The 30-year actually ticked above 5% recently. It's come back down below that. That's been a very, I guess, a negative sign for investors. Interest rate sensitive parts of the economy, interest rate sensitive sectors of the stock market, real estate. You're looking at utilities, which usually they don't grow an awful lot, these stocks, so they are bought for the dividend they produce. Now, of course, if they're paying only a 4 or 5% dividend, and you can make over 5% in a 30-year government treasury bill, why would you take the added risk? Which is what Bryan said in our interview. So a lot of individual names, a lot of sectors of the market have been being sold off because people are just moving their money into the safe haven of the bond market, especially on the shorter end. So as we see interest rates rise, we are definitely seeing the stock market pull back. And I think individual investors need to take notice of that before you make your investment decisions. And we have another chart here, and it's probably the most important part of this chart is to the far right-hand side. And this is the 2 and 10-year treasury yields. And what you'll notice, this brownish, reddish part in the, I guess, all the way to the far right. And that tells you, or that shows you, that the yield curve is inverted, that the 2-year is paying higher interest than the 10-year right now. Although we are definitely seeing that spread narrow, the 2-year now, at one point, was 1% difference between the 2-year and the 10-year. Now you're looking at maybe 30 basis points, 40 basis points. So that spread has narrowed, and that tells us that the yield curve is hopefully getting out of this invertedness, if you want to call it. So hopefully things will get back to normal, where longer term bonds or GICs are paying higher interest than shorter term ones. And that would be more of a normal bond or normal bond market. Second point I wanted to make for individual investors before you make your investment decisions is to be patient and look for a change in tone for the markets, or of the markets. And as I said earlier, October tends to be the month that things turn around. You come in after the worst month of the year, which is September, and you move into October. And what we usually see is after Canadian Thanksgiving, after, say, the first week of the month, we usually have Canadian Thanksgiving, and then somewhere around mid-month, you start to see things turn. And I have a chart here of the S&P 500. And you will notice that, just take a look at last year, we have it here kind of towards the right-hand side as well. Things really turned around in the month of October. We saw the market start to pick back up. We actually saw interest rates, or the increase of interest rates, start to slow down. And we hit the ground running as we moved into 2023. So at the end of 2022, October, we saw that turnaround, which we tend to see more often than not. If you go back, I guess, a few years, you'll notice that October 2021, the markets continue to move higher as well. And even in 2020, coming out of, I guess, the difficult times of COVID, we see a turnaround in March, April. That was kind of the inflection point there. But even if you look at where October is in that chart, you'll still see that, or you will notice that the month of October was still a good month where the markets came in lower and ended up higher, and November was higher as well. So overall, it's been I guess a time. October is a time where we see a turnaround. And I know you can't time markets. We talk about this all the time. You don't want to try and time markets, but you definitely want to look for a change in tone of the market. Perhaps we're seeing it already. And what I mean by that, well, we're seeing higher interest rates this week, as a matter of fact. And yet Monday, the NASDAQ was higher. And the NASDAQ is primarily tech stocks. Tech stocks trade on the NASDAQ. And we know tech stocks usually fall. They're interest rate sensitive when interest rates move higher. Today, before we did this show, interest rates were also still at relatively high levels, highest levels we've seen in 16 years. And yet the NASDAQ was higher as well. So perhaps that, I guess, sign that I'm looking for, that investors should be looking for, maybe that's one of them, that tech stocks kind of break away from that interest rate higher, tech stocks lower scenario. And now maybe we're starting to see a bit of a difference in tone. The market for tech stocks, for the NASDAQ, and maybe for the overall S&P is starting to change. So look for that change in tone of the markets. Our third point that I wanted to stress is something we talk about all the time on this show, corporate earnings. Corporate earnings obviously come out 4 times a year, and they're very crucial. And this time is no different. We're going to hear from the big bank CEOs out of the US. They kick off the earnings season. We'll hear from JP Morgan, Bank of America, and other US banks as well, Citibank. What are they saying about the economy? What are they saying about their individual companies, how they're doing themselves? Their shares will definitely reflect what they say. And I think the stock market may be influenced by what these CEOs are saying. Jamie Dimon, the CEO of JP Morgan, he's never hesitated to talk about or to tell us what he thinks is going on out there, give his views and his opinions, and they can at times move markets. One chart I have here, or a couple of charts I have actually. First one is Bank of America. You'll notice that Bank of America is trading at a new 52-week low. Yes, a new low for Bank of America. The dividend has gone up. It's now getting closer to that 4% mark. But if you notice on the far right how the stock has really tailed off, and Bank of America, obviously for those that can handle the risk, is something that I've looked at closely. JP Morgan, the next chart here, as I mentioned, biggest bank in the United States, one of the biggest banks in the world today, hasn't fallen as much as a Bank of America has, but still you've seen a tail off in their share price. So let's focus on what these CEOs, especially of the banks, say in the next 10 days or so. But after that, all the CEOs that come after them, bank CEOs, tech CEOs, and just industry in general. What are CEOs saying about their businesses? What can we glean from what they're saying about the economy? And I think that, combined with where interest rates are, I think that's going to be very important to give us a signal as to how you should be investing over the next couple of weeks. State of the market today, and we've touched on it throughout the show already, but as I said earlier, I think coming into September, for example, we saw the market coming in near a 52-week high, and we actually have an S&P 500 chart that would show us that. You'll see here, it's actually a more condensed chart. It's a 6-month chart of the S&P 500, and you'll notice that we did lose some steam in August for the S&P 500. And again, I always use the S&P 500 because it is the largest index in North America. And you'll notice here that in August, we did have a downturn, but towards the end of the month, we picked up again. Coming into September, we were at 52 or just off 52-week highs. The multiples, PE ratio, as I always talk about on this show and other shows, was 18 to 20, which again is historically high. Interest rates were high. Oil prices started to move higher. So we had all the makings of, well, maybe September could be a bit of a down month, especially since we came in on such a high. And we saw that in September. Well, now we're moving into October, and I think it's kind of the opposite. A lot of negativity out there. Oil prices are still high. United States, they have political issues, right? We just saw the speaker be kicked out of his position. We're seeing, interest rates continuing to move higher, slowing of the economy continuing to happen. Right now, everywhere you look, we're seeing negativity. So maybe now it's time to be that contrarian. Maybe it's time to take a look at things because we're coming in at a low point versus a high point into September. We're coming into a low point in October. And as I said earlier, I think we're at a time now where we can look for some sort of catalyst to take us higher. And hopefully that catalyst will be central banks saying that if they are going to raise interest rates, perhaps it's one and done and move on from there. But overall, I think it's a good time to look at being an investor, put money to work, because I think a lot of things have gotten a lot cheaper in the last 6 weeks or so, maybe the last 8 weeks or so. And I think you can find some really good bargains. As I said, I think the state of the market coming into October is at a low point. And I think for those investors that have money to be able to put to work, I think it's time to sharpen that pencil and make that list, because I think now is the time that you could start looking at some of those names. Market's looking for certainty. What do I mean by that? Well, simply put, they're looking for the central banks to provide us with some certainty with respect to interest rates. How much higher can interest rates go? How many more times can central banks raise their rates, the bank rate, the Bank of Canada rate, and therefore, obviously, prime rate goes up with it. We've already seen mortgages, especially in the US, getting close to the 8% mark. Here in Canada, if you're looking to get a mortgage, perhaps you get a bit of a discount, maybe prime minus a certain figure, but there are many people that on a variable rate mortgage right now are paying in the 6 to 7% range. We know that many people on fixed rates, a lot of those fixed rates, or the majority of them, will come due for renewal by 2026. So they're going to experience, a much higher mortgage rate when their mortgages come up for renewal. So what certainty am I looking for? Well, I'm looking for the banks, or the central banks, I should say, to come out and tell us, this is it. We're raising one more time and we're done. Or we're not raising for the foreseeable future. And I think once we get that, I think markets will gain some traction. And I have a chart here we can look at, and it just shows us the federal funds rate increasing since 2022. You can see really the only certainty that we had over the last little while, last year or so, has been that the central bank, Federal Reserve, is raising rates. And just in the last few meetings, you'll notice the June meeting, the September meeting, there were no rate hikes there, which is a good sign. So the question is, will there be another rate hike come the beginning of November, end of October? And right now, I think the odds for the Fed to raise rates are somewhere around 35–40%. I wish they were lower, but unfortunately not. There's been some conversations from Fed governors that they will raise rates one more time. So we'll have to see. We'll have to see what the data tells us. I think we had some strong data just yesterday. The JOLTS, which are job openings in the US, was high, which we don't want to see. But we saw some data come out today, which kind of told us the opposite, some softer data, macro data in the US. So overall, it's going to be an up and down sort of thing. Like Bryan said in our interview earlier, I think it's going to be a bit of a choppy market. But I still believe that if we can get some certainty with rates, which has been the biggest issue for the markets at this point in time, I think these markets can gain some traction, and especially some of the interest rate sensitive parts of the stock market, I think those sectors can move higher. Risk versus reward. And it's something that I talk to people about every day, right? You help people manage their money. You're always talking about what's the risk involved if you buy this investment, but what is the potential reward? And obviously, I guess all of us want the least amount of risk with the most amount of reward, right? That's how we all would love to see it. But unfortunately, the least risky things produce the lowest returns usually, and the more riskier side of things produce or can produce higher returns. But of course, they can also produce loss, unfortunately. So whenever you have risk versus reward, you obviously want to look at a number of things. And the first thing you want to look at is, what are your objectives? What do you want your money to do for you? What do you require or need from your investments? Do you need some sort of income? Do you need your investments to generate an income for you? A lot of people don't have pensions. They require or they need their portfolios when they retire to produce an income for them in retirement so they can live the life they want to live. So what are the investment objectives? And then, of course, what is your risk tolerance? What can you tolerate for risk? The first chart I wanted to show here, I think actually it's the only chart in this segment. Actually, no, there's two charts here. Is this real return of a GIC. I can't tell you how many people are asking me about GICs, short-term bonds, money markets, high-interest savings accounts, you name it. They're asking me a lot about this at this time because interest rates on, let's say, a one-year, let's call it money market fund, is now about 5%. If you go out maybe a year and a half, I've seen some 1 year or a year and a half GICs paying close or in and around 6%. Something that I haven't seen. Wow, I was back in 1999, I was selling 1 year GICs at 6.25%, interesting enough. And I haven't seen those kinds of rates since then. But this chart here on GICs, or real return of a GIC, clearly shows that if you want to take a GIC or money market fund or a high interest savings account, you could substitute all of them in this chart. And what you're going to notice is when you factor in inflation, and then when you factor in taxes, if it's not owned inside of a registered plan, real rate of return is significantly less. So here you have our chart. You look here, a 1 year GIC returns, and you can see on the far right, the return on a 1 year GIC has gone significantly higher. Difficult to see, but if you factor in your 1 year GIC after a 40% marginal tax rate, you'll notice that obviously the return is a little bit lower or a lot lower if you look at this chart. And then lastly, and probably the most pronounced line on this chart is the gold one, which says a 1 year GIC real rate of return after tax and inflation. When you factor that in, you'll notice that the real rate of a GIC is actually negative. You make, let's say, 5-6% on a GIC. Today, the inflation rate in Canada is 4%. You take away a bunch of that for taxes. Yeah, maybe you squeeze out a slight return, maybe 0.5%, but that just doesn't cut it if you're looking for growth in a portfolio. So what I always say is this: if you're looking to just get by, if growth is not important to you for your portfolio, yes, today you could buy a GIC, a low-risk bond, short-term bond, a money market fund, because your money can be, other than GICs, your money is liquid. You can get at these money market funds, high interest savings accounts whenever you need the money, and they're paying a 5% or close to a 5% rate of return. However, when you look at the S&P 500, as Bryan mentioned earlier, S&P 500 right now is returning about 11% for the year, double what you're getting on these short-term instruments. So once again, are you looking for growth, or are you looking for low risk, just stay the status quo? And here you have a chart of the S&P 500, and you can see that, yes, there's an opportunity for loss, and the red are the years that the market or the S&P went down. This is a 30-year chart, by the way. You'll notice that in 2 years, the losses were minimal, and it's really only 6 years out of 30, the markets were actually down significant enough that it made a dent in people's portfolios. So what does that tell us? Well, more often than not, the stock market goes higher. The down markets tend to be shorter lived. The up markets tend to be longer. The down times sometimes are a little steeper than the up times. If you take away 2001 and 02 in that area to the left, you'll notice that really in the last 23 years, there have only been 3 times the market's gone down in the last 20 years after we got through 2003. So investing in the market for potential reward is definitely there. And at the end of the day, what it comes down to, whether you invest in the markets or whether you take a lower risk approach, comes down to your risk tolerance and investment objectives. And when people ask me the question, Allan, what should I do? I will always turn it around and say, what do you want your money to do for you? And that will always dictate whether you should be in the market or should be out of the market in some interest-bearing investment. So I thought it'd be kind of fun to talk to all of you today about the top 3 questions that I've been getting from individual investors. And the number one question I've been getting recently is, with so many negatives in the economy right now, is it a good time to invest? And this has again happened in the last, call it, month or so, since September has been such a weak month. And I guess my answer to that question very simply is, yes, you should be in the market. It's very difficult to time the market. Get out on September 1st, get back in on September 30th, or sell in May and go away, sell in May and come back in October when you're supposed to, quote unquote, supposed to come back in, because we know the period between May and October underperforms the period between October and May. But that would entail timing the market. And we don't like to time markets. And on top of that, if the markets have come down in September, what a time to buy. You know, I've talked to a number of investors over the last week, and they've said, Allan, why are you buying this? It's struggling right now. And my answer is, yes, I'm buying it because it's struggling right now and because the price is so low. If it was not struggling, the price would be much higher. And who wants to buy high to potentially sell lower later? We want to buy low, a good quality investment, to potentially sell higher later. And that's why I think, yeah, individual investors should remain invested, even though there are so many negatives in the market right now. The number 2 question on our list, we can pull that back up, there we go, is, oh, that's the wrong list there, is should I have all my, there it is, should I continue to have all my money invested, or should I pull some money out of my investments to pay down some of my debts, like mortgages, like my mortgage? That's a question, again, I've been getting a lot throughout the year. And as I've said on other shows, and I think my last show, we've seen a lot of individual investors pulling money out of their savings, out of their investments to pay down debt. And I guess the best way to know if that's what you should do is, what is the interest you're paying on your debt? That will make a difference. If you're lucky enough to have a fixed rate mortgage, let's say as an example, and still paying a 2% interest, well, I think you'd be better served putting your money in the market, because I think you'd make more than 2%. If you're unfortunate enough that you are in a variable rate mortgage and that mortgage is now 6-7%, or if you're in a line of credit situation, or if you have a loan that is greater than 6-7-8%, 8% if you're in the US, their mortgage rates are getting up there, then perhaps you want to start paying down some of that debt. So I think it all comes down to what the rate is on your debt that you have. That will dictate what you should do. Pay off the debt fully, pay off some, or invest in the market and continue to hold that debt. The third question that I've received most often over the past, let's say, a few months or so is simply, do I think, there it is, do you think the Bank of Canada will raise interest rates again? And I was on CP24 not too long ago. They asked me that question right before the central bank or Bank of Canada had a rate decision, and they did not raise. I believe in Canada, we will not raise. I think our economy is slowing quicker, perhaps, than the central bank even thought it would. In the US, I think they could raise one more time. I've heard some talk by Federal Reserve governors that it's probably a one and done situation. Although, as I said earlier, you have about a 40% chance right now that that will be the case. So 60% says they're not going to raise. So take that as you will. It's very difficult to know. I think we just got to continue to look at the data that comes out, the macro data that gets released by the government, to tell us exactly how the economy is faring, how inflation is, how the battle against inflation is going. And that will tell us whether or not central banks will raise maybe one more time. So now the part of the show that I like most, as I always say, where I get to take some questions from all of you, those in the audience watching today. And I see a pretty good question here. Can you please comment about where you see good opportunities in the market right now for investors? And a great question, very timely question. So I guess, again, it depends on your risk levels, your investment objectives. But if you're someone with a medium risk tolerance and let's say a growth mandate, looking for growth of your wealth, of your portfolio, I think right now, to be honest, there are a lot of places in the market or in the stock market you could find good value. I talk about tech all the time, especially the semiconductors. I think you can circle back to them. I said that on my last show. Some of the names, AMD, NVIDIA. NVIDIA has moved up recently. I know Goldman Sachs has put some of these names back on their conviction buy list. So maybe take a look at some of the tech names. I think you could look at bank names. But with bank names, as I've said in the past, I think you need to be a little patient. I don't know how quickly they're going to move up with a higher interest rate environment upon us. But perhaps if we get certainty regarding interest rates, bank stocks make sense. But again, you could look at many different stocks in many different areas of the market. If you want, I can look at a name like United Rentals. Name like United Rentals definitely can move higher, over the next, let's call it 6 to 12 months. United Rentals produces heavy machinery so that they actually rent out heavy machinery. A little different than Caterpillar. Caterpillar actually makes heavy machinery for you to buy. United Rentals makes or rents out heavy machinery. So overall, I think if you're an investor today and you have an opportunity because you have some money on the sidelines, or if you have money available, I think now is a great time to get into this market. And if history or seasonal factors or any indication to us, October, hopefully we'll have a change of heart. We'll come in at a low, leave at a high point for the month. November will be good. Hopefully we get a Santa Claus rally in December. So I think there are a lot of opportunities right now. You just have to do your homework or call your investment advisor or call me to find them. I think we're up against the clock, so I won't take any more questions. I know there are a few questions left to be answered right now, but I think I'm going to wait till the next show to maybe answer some of those, or maybe answer them over the next couple of weeks. So what I want to say right now is thank you to all of you for watching our show today. As I said, a turbulent time, a volatile time for investors. Investors have a lot of questions right now, and I always try to answer as many of those questions as I can every couple of weeks on our show, every few weeks on our radio show, News Talk Radio. And I guess until we meet again, which is our next episode, which will be Wednesday, October the 18th at 12 noon, I wish you all a good, successful investing and happy investing.